Welcome to Ainsley News. It's Tuesday, the 6th of October. Welcome to the week. If you've enjoyed a holiday yesterday, I hope it was great. Today we're talking about Australia doubling down on our debt. For years, Australia has been ranked 1 or 2 in the world's most indebted households. Conversely, our government debt has been one of the lowest. 2020 would mark the year that household debt eased and government debt exploded. However, changes to lending laws and yet more stimulus for new housing, together with a record deficit-funded rescue package, might see both end the year on a high, sadly. Up until the GFC, Australia's political agenda of running a surplus saw our government debt fall to less than 10% of GDP. Rudd's response to the GFC saw that explode higher in percentage change terms, but still relatively modest in quantum on global stage, given the very low base from which it came. This next chart here, just showing our movement in debt versus GDP over the years. Whilst not officially a recession in Australia, the GFC certainly saw a reprieve in household borrowing as people reined in debt until rejoining the binge in 2013. Reaching a peak of nearly 190% of disposable income, nearly tripling in 30 years, household debt has seen a modest decline in 2020 to just 185% of disposable income. This next chart here is showing our household debt as a percentage. Before we start high-fiving, let's just remind ourselves just how we stand in the developed English-speaking world measured against GDP. Yep, that's us way up the top there. Australia with that darker line in the next chart showing household debt to GDP. So we're winning. However, that decline is not just cricket in Australia, and so the government has decided to propel our reliance on debt-funded property to higher highs by introducing home building grants and more recently abolishing the respondable lending laws brought in during the GFC, as Frydenberg sold it. As Australia continues to recover from the COVID-19 pandemic, it's more important than ever that there are no unnecessary barriers to the flow of credit to households and small businesses. This not only lowers the bar of entry into the housing market, but it also increases the size of loan for those already eligible. This from CanStar. Mr. Mickenbecker assumed rolling back to the requirement of heavily scrutinised living expenses would lead to the assessed level of expenses going down, allowing the average person to get a loan 70% or $70,000 larger. This subprime lending approach has previously worked brilliant for the US housing market. Combined with the prospect of still lower interest rates to come as the RBA is widely tipped to lower rates this year, that dip in the charts previously shown is likely to head upward again. Despite the huge increase in total debt, the actual repayments have been relatively steady, and indeed since interest rates cuts in 2019, even falling. So this next chart here showing debt repayments to household income. Looks like we're still winning that race there too, in a way. But herein lies the trap. We are in a macro deflationary environment at the moment, and the Australian government and central bank, along with every other one around the world, can and will throw the kitchen sink at getting us back into real inflation. As we discussed last week, debt plus inflation equals insolvency. Yesterday we got a reminder of how close we are to deflation, with the Melbourne Institute releasing its monthly core inflation rate, hitting just 0.1% for September, but also for the year, and the trend heading to zero and beyond. This next chart here showing monthly inflation gets pretty messy there at the end. This week we'll see the government unleash a record deficit spending budget in a desperate attempt to stimulate the country out of the worst economic contraction since the Great Depression. Deficits, of course, mean more debt, and so we will see the double whammy of both public and private debt increasing. Near zero interest rates will make all that seem manageable. However, the spectre of a flip to inflation, or more critically to stagflation, where inflation rises within a weak economy and high unemployment, should prudently be at the front of people's minds. History is littered with previous examples of where massive monetary stimulus thrown at a deflationary economic environment ends in a violent and uncontrollable hyperinflationary period that brings the economy down. The alternative is the Japanification model that sees decades-long anemic growth alongside ongoing more and more stimulus amassing nothing but debt. And that amongst other statistics showing that our wages are actually decreasing rather than increasing. It's a tough time for Australia looking forward. Well, that's news for today. Thanks for joining. Remember, ainsleyBullion.com.au for everything gold and silver. Ainsley Wealth for everything cryptocurrency, if you're keen on checking out Bitcoin. And goldsilverstandard.com if you're interested in our gold and silver-backed cryptocurrency built by Ainsley. We'll catch you tomorrow for more news.